Hello students, let's practice the variance analysis in the flexible budget and a static budget. We want to understand why we have to use the flexible budget instead of the static budget in terms of this variance analysis. And we want to focus on the cost variances. Okay, let me read this question. The worker transportation company's general manager reports quarterly to the company president on the firm's operating performance. The company uses a budget based on the detailed expectation for the forthcoming quarter. The general manager has just received the condensed quarterly performance report shown below. As you can see that we have all this financial statement information in actual and static. So let's create the variance for the static budget. Static budget variances can be calculated. How? Yes, we just use ABS function. ABS function, just difference between these two to get the absolute value. So the variance we created, then I want to just fix this unnecessary part. Then let me just fix all this part. Okay, we calculate all the variances, the difference between the actual and static. So let's put this favorable or unfavorable the variance, the identification. So when the revenue, the actual is lower than the static budget, then that is unfavorable. When the cost, the fuel cost is in actual is lower than the static budget, then it's very favorable. Then in the same way, but it is unfavorable because the actual spending is greater than static. Then we found huge favorable the variances in the variable payroll part. Then finally we have which one is bigger, right? The static budget is bigger, the actual is lower. So the total variable cost is 126,000 favorable. And then supervision, the fixed cost, all the fixed cost of the static budget variance is now unfavorable. You can put just the favorable or not, doesn't matter. Then the favorable, this is unfavorable in the fixed cost. Total cost is favorable because the actual spending is lower, right, in total. And then the operating income is unfavorable because the income is lower than the static budget. So let's just analyze using the variance report. If you can see this, the total variable cost, the favorable is $126,000. So it is higher the total variable cost in static budget than this actual. So $126,000 as favorable. Then the total variable and the fixed cost 160,000, the favorable. But operating income $140,000 unfavorable. Based on this analysis, although the general manager was upset about not obtaining enough revenue, she was happy that her cost performance was favorable. Otherwise, her net income would be even worse. The president was not satisfied with the performance report and remarked, I can see some merit in comparing actual performance with the budgeted performance because we can see whether actual revenue coincide with our best guess for a budget purpose. But I can't see how this performance report helps me evaluate cost control performance. Now we want to focus on the cost variances when the actual activity level, which is the revenue, are the same between the actual and the budget, so that we can focus on the flexible budget, focus on the cost variances, like this. So requirement, prepare a columnar the flexible budget for worker transportation at the actual revenue levels of 12,700,000. Assume that the prices and the mix of products sold are equal to the budgeted price and mix. Write out the flexible budget formula for variable cost as a percentage of revenue. We are going to use the percentage of the revenue when we measure this fuel variable cost, the repair variable cost, and the supply and the variable payroll cost in the flexible budget at the activity of 12,700,000 in revenue. And then prepare and condense the table showing the static budget variance, the sales activity variance, and the flexible budget variance to see all the variances in the big picture. Here you go. So flexible budget, we are going to use the formula, the flexible formula percentage of revenue. How do we calculate it? Okay, static budget. And then certain percentage of this, the revenue, out of revenue and the variable cost. So this variable cost divided by the revenue should be fixed. Then, oh, what is this? Okay, then I'm going to just drag down so that you can see that all this, the formula now calculated as a percentage of the revenue in static budget. The reason why we can use this static budget, the formula in the variable cost as a percentage of revenue, is that in the different activities, we use the same proportion of this variable cost, like the cost per unit or the portion of this revenue. And then when the revenue increase or decrease, this variable cost also increase or decreased. So we can use this formula. And then let's apply this 4% into this new activity level. Then I'm going to fix this, then drag it to the down so that we can get this, the variable cost, each variable cost into this, the flexible budget, the new, the activity level 12,700,000. Okay, and then the fixed cost is going to be the same as the static budget level. We are using the same level of the fixed cost. So we got it. And then total fixed and variable cost is the sum of these two. So 11,924,000. 11,785,000, comparing this, the total variable and fixed cost in static budget. Okay, so let's calculate operating income. How to calculate it? Get the revenue minus total variable cost. So we have the new operating income in the flexible budget. Then let's calculate the variances. Once this formula, remembering all the cells are remembering this formula, so you can just copy and paste. By doing so, we can use all this formula along the way, the difference between the actual and flexible budget. Then let's put the favorable or unfavorable, focusing on the variable cost. 8,000 is unfavorable because the actual cost is greater than the flexible budget. Also unfavorable. Every cost, variable costs are unfavorable. It turns out the unfavorable, and then all the costs except for this other fixed cost, which is favorable, all the costs are now turned out unfavorable, and operating income is definitely unfavorable. So let's compare between this static budget variance and the flexible budget variances. If we just compare this variable cost between actual and static budget at the different level of the activity, we would misunderstand the variable cost is favorable, because in the static budget we expect we can sell more products, so the variable cost definitely get increased. So the actual level is when the actual level of activity is lower than static budget level, then definitely the total variable cost in actual is lower than the static budget. So in this case, in this static budget variances case, we cannot accurately measure the variances when it comes to this the variable cost. But when we match the activity level between actual and the flexible budget in terms of the revenue, now we can compare the variable cost in actual and flexible budget. The variable cost in flexible budget are now the fairly compared. So we found out, okay, the total variable cost in the flexible budget variance is 129,000 unfavorable, which is failure of the cost management. And then total variable and fixed cost again 139,000 is deteriorating. That's a lot of what is this? Okay, I just calculate the wrong result. Oh, sorry, it's the right. So you can see that we have wrong result, the different result from this the static budget variances. So let's put these two variances into the one variance report in order to understand this the total variances in a big picture. Actual result, we got the actual result of the revenue, and then the variable cost. Where do we have the variable cost? Variable cost in total, in actual, and then contribution margin can be calculated. Just less the variable cost, and the fixed cost is 1 million, and then total variable and fixed cost is just the sum of these two. And then operating income is total revenue minus total variable and fixed cost, so 776. Now let's collect the flexible budget for actual sales activity. Flexible budget 12,700, and then less variable cost. Variable cost. Then the difference between two is the contribution margin, and less fixed cost. Where is the fixed cost? There you go. This flexible budget, fixed cost 990. And then the total variable and the fixed cost is 11,785,000. And then this operating income, we can calculate just the revenue minus the variable and the fixed cost, all the cost. Now let's collect the static budget information. Static budget 13 million, and then variable cost 11 million, Then we subtract. So we got the contribution margin. And then the fixed costs on the static budget is 990,000. And then total variable and fixed cost is 12 million. And then finally, the revenue minus total variable and fixed cost, we got it. Now, let's use ABS function between these two budget. Then let's drag to the down. So we have the variances. Okay. In the same way, I'm going to use this function. And then let's write down the favorable or unfavorable. Again, all are unfavorable because actual in the variable costs in actual is greater than the flexible budget. And then contribution margin is lower than the flexible budget. And then total variable cost and fixed cost is greater than this flexible budget. And then operating income is lower than the operating income in flexible budget. So all are unfavorable. Then how about this? The sales activity variance between the static budget and flexible budget. Okay, it's unfavorable, but the variable cost is definitely favorable because we have a different activity, which is lower activity in the flexible budget than the static budget. So the variable cost is definitely lower than this static budget. And then contribution margin also lower because here we have the lower the contribution margin in the flexible budget. Let's skip this. And then also the favorable total variable cost in a lower level of activity in a flexible budget. Then operating income is lower, so unfavorable. So we analyze this variance report. And then static budget. Static budget is just sum of these two. So let's calculate ABS once again. ABS of this actual and static. So actual and static. Then let's take it down. So we found out all the variances. Okay, so the 300,000, the static budget is higher than the actual. So this is unfavorable. But you can just use these two sum of these flexible variances and sales variances is same as the static variances. Okay, anyway, it is the same, the variances, the same outcome. So here 126, the static budget is greater than this 10,900,000, the variable cost. So it's favorable. Okay, or you can use this way. The favorable sales activity variances is favorable, and 129,000 is the flexible variance is unfavorable. Which one is bigger? Right, favorable is bigger. So 255,000 minus 129. So we got 126,000 favorable because the favorable sales activity variance is greater than the flexible budget variances. We use this formula. Flexible budget variance plus activity level variance is equal to the static budget variances. we have the same result. Let's keep this the way. Here the static the sales activity variance is unfavorable, so we can just sum these two up. Then 174,000, which is unfavorable because both are unfavorable. Then fixed cost, we can just sum these two up, and then unfavorable. Then you can see that the favorable in sales activity variance is greater than the flexible budget variances. So we have to subtract from these two flexible budget variances. So it is favorable. Why? Because the favorable sales activity variance is greater than this flexible budget variances. Finally, unfavorable. So we can just sum this up. So still unfavorable both. So this variance report is showing all the revenue, variable cost, the contribution margin, fixed cost, the profit, and the revenue in the big picture, including all different types of the variances analysis: flexible budget variances, the sales activity variances, and the budget variances. Okay, so please remember that the reason why we are using the flexible budget is that we want to analyze the variable cost, the variances at the same level of activities, so that we can avoid some distortion of this misunderstanding the total variable cost variances. Okay, see you in the next video clip. Bye bye.